This is TV18 and you're watching CNBC TV18.
Co-powered by SBI, Solid Bank की solid backing.
Hello and welcome to this special broadcast on the macroeconomic data that's just flashing on your screen. The July CPI, consumer price inflation, has come in at just 3.54%. The CNBC TV18 poll was 3.64%. The Economist poll was 3.7%. So it's way lower than what the expectations have been on the street. So 3.54 is the CPI number for the month of July. The food price inflation is only 5.42%. That also is a positive, simply because last month, June, it was 9.36. The CNBC poll was 5.5. So it's largely in line with expectation. The fact that it is 5.4 is obviously a tad better than 5.5. So actually on both counts, the headline inflation number as well as the CPI food number, I think these are very good numbers. Let's look at the internals. The vegetable index is the most important because that had shot up 29% in June and was singly responsible for taking the food inflation to 9.36%. The vegetable index is 14% up year on year. So that is important, that there is a substantial fall in the pace of inflation as well in vegetables. Cereals and products are up. Okay, this is on the month. I'm sorry, this is on the month. I'll get you the YOY in just a bit. We should have that as well. What's the vegetable inflation year on year? Give me a minute. Yes, here we have it. The vegetable inflation year on year is only 6.83%. That's a very big fall from the 29% that we had last month. That is for the month of June. Remember, tomatoes going at 120 rupees and 100 rupees. So clearly that has been brought under control. Pulses are still expensive, 14.7% higher year on year. It was 16% in the month of June. So even that is an important improvement for the month of July. But the important part is that a large number of food articles have started falling. So cereals is up 8.14% year on year. That's still a bit high. Meat and fish 5.97 or almost 6%. Eggs is 6.76. Milk is the one that's bringing the average down for food products at 2.99%. Edible oils, of course, have been the strength. They've been lower for a goodish bit because the year-on-year comparison is with the post-Ukraine war high. So it is minus 1.17 year-on-year on oils and fats. Fruit is up only 3.84. Again, that's a deflationary impact. Vegetables up 6.83 is a very big improvement over the status from June. And pulses and products still somewhat high at 14.77, as I told you. Sugar up 5.2%. All told, we have the food inflation rising only by 5.4%. If you take food and beverages, then it is 5.06%. So that's a very positive number. The miscellaneous, which normally represents the core inflation, is up 3.79. I should be able to give you the core inflation in just a minute. Yes, it's coming at 3.4. Now that's the worry, okay? Because core inflation was 3.1 in June. That's rising to 3.4. This is probably the telecom price hikes, but we will get to our experts when we are discussing it with them. But at the moment, that's an important number. Okay, let me see whether I can give you any details of the IIP number. The June industrial output number is a disappointment. It's come in at 4.2% versus just 4% year ago. So you can't even complain of a high base. The June industrial output perhaps is a bit of a disappointment. The capital goods growth is a disappointment. It's up only 2.4%. It was bad year ago as well, 2.9%. Consumer durables output is 8.6. That's the positive, but it has a very low base. It's minus 6.8 year ago. And the consumer non-durables is minus 1.4, which is a bit of a disappointment because consumer non-durables is normally associated with rural areas not consuming enough. At the moment, the consumer companies are also speaking of an urban slowdown. and rural recovery. So anyway, consumer non-durables coming in at minus 1.4 would be a bit negative. Perhaps the positive is that May industrial output has been revised higher to 6.2 from the earlier 5.9. But I must tell you that the June industrial output is the only disappointment in the whole thing. Otherwise, the macro data is looking very positive, especially the 3.54% inflation. Just a word before I go to my guests. The 3.54 is below the mandate given to the RBI MPC that you have to keep inflation below 4%. Wow, 3.54. So can we expect a rate cut? No. As the Reserve Bank said, this month you will get a low number because last year in July we had a 7.4% inflation, again because of tomatoes and potatoes. So the year-on-year effect makes this number look low, but it will iron out by the time we come to the third quarter, and therefore the Reserve Bank is not going to be moved by the 3.54 number. With this preface, let me welcome our guests. From the fixed income side, the bond side, we have Devang Shah. He is the head of fixed income at Axis AMC. But first, I will go to the Economist. Aditi Nayar, the chief economist at ICRA, Sakshi Gupta, VP and senior economist at HDFC Bank, and Nikhil Gupta, the chief economist at Motilal Oswal, are with us. So, ladies and gentlemen, thank you very much for your time. Nikhil, 3.54 looks like we will undershoot the Reserve Bank's forecast as well. They have upped July, August, September to 4.4, as you know.
Hi, Radha. Thank you very much. Okay, so 3.54, yes. I mean, I think the consensus was 3.6%, which was similar to what we were expecting. And if I remember correctly, RBI is forecasting 4.4% for this quarter. So our forecast, we believe that it will be 4.4% because we believe this is the bottom in July. We expect it to move up to 4% next month and probably 5% in September. So for this quarter, we are not seeing lower than expected inflation vis-a-vis RBI expectation. 4.4% is 4.5% where we are seeing it.
I read out the constituents to you. Vegetables appears to have clearly gone down from that 29% to 6.8 or thereabouts. Is that a big breather? Can we expect that we are going to see food inflation under control, Nikhil?
Food inflation, Lada, was expected to be closer to 5%.
5.5 was my average. And it's come in at 5.4.
Right. Even vegetables, month on month, I think the acceleration was expected to be the same as last month, which was close to 15%. But because of the base effect, we were expecting it at 7%. I'm not sure what exactly it is.
That's very.
But I think broadly the numbers are similar. But I heard you said core inflation is at 3.4%.
Yes.
Which is slightly higher than what we were expecting. So we need to go into details to see what exactly is led to that.
Okay. Well, Aditi, your thoughts first. At 3.54, does this undershoot? And again, any concerns on core climbing?
Thanks, Lata. So, a couple of points. On the food and beverages side and on the miscellaneous side, the numbers are very much in line with what we had penciled in. We were a tad higher at 3.7%, and I think our miss has come from fuel and light. So maybe, not at least core or vegetables, which have been areas that we've been concerned about. Now, going ahead, we are actually expecting a flattish print in August, unless we have a lot of disruption in the next few weeks coming in from heavy rains on the perishable side. After that, as Nikhil said, we're expecting a jump back up in September. But for the quarter, we still think that the average is going to undershoot the MPC's recent projections. So there may be a little bit of cushion over there, at least in terms of what the MPC had penciled in for Q2. But all this good news is basically the base. I mean, going ahead, I think we do need to remain very watchful of how the rest of the monsoon season plays out and what starts creeping into core, because core is, once something comes into core, it tends to be very, very sticky going forward, and that is definitely something we need to be more watchful of. We do think that core is going to continue to inch up as the year progresses, and therefore, any base-related relief coming in from the food side is really going to be very short-lived.
Okay. Well, that point is taken. We'll be just surprised by viewers. What Aditi is referring to is Year ago, July was 7.44. But with every passing month, inflation kept falling by 1 percentage point, and it falls to 6.8 in August. September was 5.02, and October was 4.87. So the year-on-year effect, even if the inflation index rose only say 0.2% month on month, you will have a yawning 5% or so by the time you come to the third quarter. And remember, that's when you have Dussehra and Diwali and the festive months. So, you must not be celebrating 3.54 too early. There is every reason that these inflation numbers could pick up. Just arithmetically, just because of the base. Sakshi, to you, how much should we worry about the core? I'm asking you again, because while my guess is this is the telecom numbers getting in, there is also a global disinflation because of China. We are seeing copper at 4-month lows, we are told, and we saw crude also touching 76, it's sub 80 even now. So should we really worry so much about core?
Well, Lata, I think that, the core inflation number, part of the increase that we've seen, we were expecting core to be at around 3.5, so it's very close to what we were estimating. Of course, a part of this is because of the rise in gold prices and the tariff, changes that we saw in the month of July. But I think, going forward, our view is that we've passed the bottom on core inflation now, and we would expect core inflation to kind of go up above 4% from September onwards. I think that, yes, there is a deflationary impact from what is happening globally and, the oversupply in China, etc. But I think we also have to take into account domestic factors. And some amount of the base effect that was kind of playing out for core is going to kind of go away. So I think that we are looking at now between 4 to 5% for core inflation by the end of this fiscal year. And what that really does and why that's important is that so far over the last 1 year, the continued moderation in core inflation kind of helped cushion some of the food inflation spikes, right? And that room or that space could kind of start diminishing as we go forward.
Fair point. Again, for my viewers, I must mention that core inflation was as high as 6.1% last February. It comes to about 5.1% by the time we come to June and July. And as Sakshi pointed out, it goes down to 4% by the time we come to October, November. So on a year-on-year basis, this high base that you were getting will start lowering, and therefore on a year-on-year basis, even if the prices remain the same, the core inflation will look higher. But let's see how much they fall because of the China effect, or even slowdown in the US as the non-farm payrolls indicated. I'll come to those points in just a minute with the other economists, but Devang Shah is waiting by patiently. Devang, does this make any difference to the bond prices, the fact that inflation number is even lower than what the Reserve Bank's hawkish statement sounded?
Thanks, Lata. So first of all, you're right. Probably the number is softer than what market was expecting. I think capital market and bond market specifically thought that because there was a significant uptick and revision in the Q2 CPI numbers, probably we thought that the number can be higher for this month. So this number will be taken pleasantly, and it will be a positive for bond markets. But specifically, I think all eyes will be on the 14th of this month, when you get the US CPI data, and that will direct the markets from what we can expect from Fed. I think if the number comes as expected or a tad lower, market will start pricing in a 50 basis of cut from Fed in September, and that can be another reason why bond markets might be happy and probably the bond yields will rally. So our perspective is this number, yes, you are right. I think it's mildly positive. Markets will not react too much on it, but a positive surprise on 14th can actually lead to bond market yields to rally.
Okay, so we are definitely going to be more concerned about the US inflation, and then of course 2 weeks later you will have Jerome Powell speaking at Jackson Hole. So clearly we have enough on our minds, there are enough distractions as far as the inflation number is concerned, but this is a positive number. You can see the legend on your screen saying inflation at 5-year lows. That's a very nice headline, and we people in the media like headlines, but please, this is a base effect. And the celebratory note in that inflation is the food inflation. The rest of it is largely base. Okay, let me come to the industrial output part as well. Nikhil, the industrial output number has come down to 4.2. Is that a source of worry? I can read out the components as well. Manufacturing is the one that we would want to do well, and that's only 2.6% higher. The slight increase has come actually from electricity and mining, which are at about 8% each.
Right, Lata. So since manufacturing accounts for almost 80% of IIP, I think headline IIP is lower than the consensus and our expectation because manufacturing has turned out to be lower. Electricity will come to know, and a part of mining as well when the core infrastructure index was produced at the end of the previous month. So yes, manufacturing 2.6 is much lower than what we were expecting. But again, like always, it's a very volatile number, IIP. It does tell me that Q1 is lower than expected. And since IIP is a key input in producing quarterly GDP numbers from the industrial perspective, yes, there is some downside. And I think that is what reflected in RBI's mind as well when they reduced their forecast for Q1 real GDP growth from 7.3 to 7.1.
Yeah.
We believe it could be slightly below 7 as well. But the point is that it will be the first quarter after many years when probably real GDP growth.
Why are you saying it can even be below 7? Is there something from the earnings numbers that was below expectation?
So earnings have also been not as buoyant as they were last year. We produce our monthly economic activity index, which suggests that it could be closer to 6.9%.
Okay.
So that is the basis based on which we are saying it could be slightly below.
Okay. Likewise to you, Aditi, is there any comment on the growth numbers? Well, just to tell you the details as well, consumer non-durables, like I said, minus 1.4, and consumer durables doing very well at 8.6. I think they've had reasonably good auto sales up until June. I think the July number was not much to write home about. And CapEx also has once again meandered with 2.4. Could be the election effect, I don't know. But the CapEx was holding up GDP as well. This quarter, it's not looking so bright. So any read through to GDP as Nikhil was saying?
No, absolutely, Lata. I mean, this quarter we were expecting that GDP growth was going to be quite dull compared to the kind of readings that we had over the course of FY24. And a large part of that is because of government capex slowing down during the election months. So I am not going to take away too much from this IIP number. Our forecast was 4.5%. It's a little bit lower than that. We knew that Q1 is going to be an underwhelming quarter because of transient reasons. And I think what's going to be more important is how things play out through Q2, especially in the second half of Q2, now that the elections and the budget are behind us. And as we move into the festive season, what kind of upticks we see. Do you get that confluence of good monsoon, good farm cash flows, and healthy demand during the festive season, especially from the rural sector or not? So, I'm not disappointed because I was expecting to have a very dull Q1 GDP growth number.
Okay. Yeah, fair point. And we are anyways squabbling about decimal points. Even Nikhil 6.9 is not a big distance from RBI 7.1. So we would be happy if we can stay in the 7 region. But Sakshi, anything you want to add to the growth numbers? There is a US slowdown. There is a global slowdown, China and US. The incremental data we are getting from global markets is not terribly exciting. And now the industrial output is also showing a little bit of a slip. So overall, your growth verdict?
Well, yes, I mean, this number was, I think, significantly lower than what we were, expecting, closer to 5% for IIP. But, IIP data, we know, tends to be very patchy. So I wouldn't necessarily read too much into this particular, single number and extrapolate a trend based on that. I still do believe that, I agree with what Aditi was saying, that, in the second half of the year and from Q2 onwards, I think there's a lot of spending from the government side that's going to happen is already happening, both from the center and states, that's going to provide support for growth. I think the only thing that is a bit concerning in the IIP data this time is the consumer non-durables print that you kind of spoke about. And we've really been banking, and most of our growth projections banks on the fact that there's going to be a consumer demand recovery which will be much more broad-based than what we've seen last year. Right, but if you start seeing signs of faltering on the rural demand side, then I think that is a risk to a 7% growth forecast for the year for us.
Fair enough. We had all the Cantors and the Bizom guys who also spoke about urban consumption slowing, and urban areas, as they pointed out, accounts for 60% of the consumption, even it accounts for 40% of the population. So there is a bit of worry about whether urban is slowing, and this minus 1.4 could be a bit worrying. I take your point that IIP is not the best of quality in terms of data. But if you marry it with the kind of anecdotal evidence we are getting from FMCG results and the market research companies, maybe the consumption could be better than we see it. But yes, the government expenditure will be strong because they did badly on capex in the May-June months, and therefore we might see perhaps a capex and therefore some kind of multiplier effect. Devang, last thoughts, what's the range for the 10-year itself? If the CPI were to come in as expected, does it stay at the 6.87 to 6.9 mark? And if it were to disappoint a bit, come lower, then what's the kind of low we can see on yields?
So, yes, I think probably if it's on expected lines, as you rightly pointed out, 685, 690 is the band in the near term. But if the CPI comes lower, I think probably bond market yields will start trending lower to 675. So that's what we believe, so that if market starts pricing in 50 basis of cut from Fed, I think there can be a 5 to 7 basis of rally in our bond markets too. Second thing, just to add on the inflation front, RBI did make a comment that if the food inflation continues to be like, if they get the feeling that it's transient in nature, then probably they can think about next steps on monetary policy. So if this quarter, if we ride the monsoon well, and somewhere down the line the CPI prints come lower than the quarterly expectation of RBI, I think our markets might get a bit excited and start pricing in some bit of rate cuts, at least a stance change. So I would say that you can guide towards 675 in the next 1 to 2 months if the CPI print is quite lower and the monsoon is as expected.
Yeah, that is always a hope, but let me also remind you that what is the Reserve Bank's trajectory of inflation? It is 4.4 in the second quarter, goes to 4.7 in the third quarter. For the last quarter, it again comes down to 4.3, but they have now given us the year ahead quarter, which is again 4.4. So, they can always say the trajectory is not going towards 4, it's going away from 4. So I'm not very sure. The RBI's talk didn't sound dovish to me at all. If anything, I was surprised. But, a 50 bips cut from the Fed in September, plus another cut in in November, can perhaps change things. We are probably talking about a global slowdown. We do not know. But let me quickly get some numbers from all the three of you economists. Nikhil, GDP and inflation number for the full year.
For the full year, we are saying GDP close to 6.5%, and the CPI inflation we are closer to 4.5%.
Okay, so as the RBI says, but 6.5 on GDP. Sakshi, GDP?
We are at 7%, and inflation we are at 4.6.
Okay, and Aditi?
For GDP, we are at 6.8. GVA, we are at 6.5. So a difference of 30 basis points over there. And CPI, we are at 4.6%.
Okay. So inflation more or less where the RBI is, just 10 bips higher. So if you are higher than where the RBI is, then perhaps expectations, Devang's expectations of dovishness may not be well supported by this team. And on growth, between 6.5 and 7, no one's as positive as the RBI, I can see, at least in this group. But even the chief economic advisor was not. He is where you all are, between 6.5 and 7. Thank you very much, ladies and gents, for joining in this conversation and helping us understand the nuances of the IIP and the CPI numbers. The message is that we have a 5-year low on inflation on the CPI print, but that's largely because of the base effect. The positive in the inflation number is that food inflation is much lower than what it was last month. Half of that, 9.36, has become 5.4. Both the headline and the food inflation are below the market expectation. So inflation clearly cooled in the month of July. But what also cooled was industrial output, and that's a bit of a negative. So it's a mixed picture as far as the macros are concerned. That's it on this special edition of the macroeconomic data. Thanks much for being with us. After a break, there's more news and views lined up for you.